Hello everyone, welcome to your YouTube channel, and today I will be talking about beer call spread and what is actually a beer call spread. So beer call spread is an option strategy which is used when a trader is expecting a bearish movement of a stock or an underlying asset. For example, you are expecting a stock to go down. There are two options you can do, where you can actually buy a put of the same strike price and in the money or at the money, and wait for markets to go. Where when you actually buy puts, your total risk will be only the amount of the premium which you paid. So it's like buying a put. But in beer call spread, what you're actually doing is creating a spread. So if you have not watched my videos on credit spread, you can go to that introduction video. This is just another strategy regarding under the same spread category, credit spread. So basically what it does is you're expecting a bearish movement, but you are also protecting your capital, protecting your trade. So all these spreads are actually designed to limit the risk basically. So whenever, as you know, whenever you sell options, you have potentially your risk is unlimited. If the stock or the asset goes in the opposite direction. So what spreads do is it's basically protects your capital, and the risk will not be unlimited anymore. And that's exactly the reason why we actually call theoretically, even whenever you buy an option, theoretically you have an when you buy an option, you have theoretically it is unlimited profits, but only there are a lot of clauses to it too. Same goes with selling options too. Selling options also means theoretically you can make unlimited loss, but credit spread strategies like something like beer call spread strategies are made and designed to make that loss completely limited, and the profits are also limited. The maximum profits gained by this strategy is equal to the credit received. That's the maximum. So basically, for example, Nifty is trading at 10,800, and you're expecting a downside move. So basically, what you actually do is you actually let me see, go through the construction. So yes, Nifty is trading as 10,800, and options trader can use a bear call spread by buying 10,850 or 10,900 and sell the strike price which says 10,800. So basically 10,800 call you will sell, and 10,850 or 10,900 call you will actually buy just for protection. So the total loss what you can make from this strategy would be the difference between the premium prices between these two contracts, and that's your maximum loss, and the maximum loss is not unlimited. Now the premium for 10,900 in our example will be less, and if actually your view is right and actually market does crash, then your put, the sell option will make money, and you will have little lesser loss from the buy position that was just bought for the protection. That's exactly the beer call spread is actually constructed. It can be constructed with the stock or any other movements, and especially whenever you are expecting a sideways movement or a bearish movement, you can actually create the spread. However, you will suffer loss if your asset actually crosses both your buy position also, and both becomes in the money, then you might be in loss. But the maximum loss only will be the difference between these two premiums of these two strike prices. So yeah, hope you enjoyed this particular video. If you have any questions or clarifications, feel free to write and I'll be happy to answer them. Thank you, and I'll see you again on my next video.